Good afternoon and welcome to HYCM's webinar, FX Week Ahead, live market analysis with myself, Giles Coughlin, a currency analyst. Hello, welcome to everybody. Let me just see who we've got here. Hi Catherine, hi Ator, hi Daniel, Deepak, hi again Emily, Jajit, Lugenda, La, Nu, Pablo, Raul, Raj, Saju. Yeah, welcome everybody to the webinar. Just people are logging on. Just while people are doing that, I'll just pop the disclaimer up there for you to read. I hope you can hear me okay. If someone could just confirm that the audio is coming through okay on either the chat or the questions mode, that would be great. So if you just let me know if you can hear me okay. Someone just pop that down. Yeah, thank you, Kelly. That's great. Great. Well, I'm coming through clear. You've heard the, had a chance to read the disclaimer, and welcome to the look ahead. And we've got another very interesting week. There's so many different things happening in the market at the moment, and we're going to be taking through some of the most significant events to help you kind of navigate your way and understand the impact and the influences that are coming on the currency markets. So we're starting once again with geopolitical issues. There's so many of them at the moment. We need to work through them to kind of keep on track of them and to keep understanding how they influence the particular currencies. We're going to look at Brexit because that was particularly in the spotlight at the end of last week. And of course, Brexit is to do with Britain's withdrawal from the European Union. There's been constant headlines to do with Brexit. So we're just going to go into the latest scenario where we are. And last week, we looked at a potential place to enter. And we'll just recap that. And that potential place to enter was against the 200 exponential moving average. We had this place marked here as a potential, a very sensible and potential entry. My entry was missed by about 2 to 3 points. So you can see I'm kicking myself now after that failed entry there. But I did flag it up last week. You can have a look on the recording to see it. I don't know if any of you picked that up or caught it. I'll just get rid of that. So that was a quick recap. And what was happening last week is there was some more encouragement had been happening about the Brexit negotiation with Theresa May, and particularly from the sort of 4th, 5th, 6th, 7th, 8th, 9th, 10th of October. There was sort of quite a lot of optimism that the Brexit deal would be sorted at the October summit meeting. Now, the October summit meeting was the 17th and 18th of October last week. And what happened was Theresa May was indicating that she had a slight tweak to the Chequers plan, that she was confident that the EU 27 nation member states would accept the slight tweak to deal with the Northern Irish border problem, which is the main sticking point with the Brexit negotiation. It's all to do with what happens and where is the border going to be located between the Republic of Ireland, which is still a member of EU, and Northern Ireland, which is a member of Great Britain. And so there's controversy about how to actually organise that border. That was the issue Theresa May was trying to solve. And unfortunately, at the summit, no one was any the wiser. And so Theresa May was suggesting that maybe there could be an extension of the transition period. Now, at the moment, Britain is set to withdraw from the European Union in March 2019. And there's a transition period that's in place. And what Theresa May was saying, well, let's extend that transition period. And that was that was not accepted by her own political party, really. It wasn't accepted by competing political parties. No one thought it was a good idea, essentially. And so she's been backtracking on that idea of a transition period, because what it was seen as a way for playing for time. And the concern was that Britain wouldn't actually leave the European Union if that transition period gets extended indefinitely, especially if it starts heading towards another election that's coming up in Britain. The chances are that a competing party might be elected, and then Britain doesn't actually leave the European Union. So no one was keen for that outcome at all. And then Theresa May is now in a very difficult place, and the pound's being sold off now, and that's because over the weekend it really materialized that Theresa May has a very difficult problem. You see, the heart of the problem is she has to negotiate with the EU in Brussels. Okay, so that's away from her nation. And then she has to go back and she has to keep her own party in step with her negotiations. And of course, she's having to adapt and adjust her negotiations because the European Union aren't accepting the outline plan that she's already agreed with her own party. So then she has to go back to her own party and say, I've had to tweak it. Now, obviously, each time you tweak it, she's going to be having to re-persuade her own party to keep backing her. You can see the difficulty here, that you can very quickly become isolated. And that's what's happened over the weekend. So there's been a lot of talk about Theresa May. She's, the big question now is that there's a committee called the 1922 Committee, and it is a group of Tory backbenchers who meet and to discuss what the frontbenchers are doing while they're sitting in the House of Commons. And what it's been suggested is that Theresa May is being summoned to this 1922 committee, and if they get something like, I think it's 48 or 49 letters to the chairman, they can trigger what's called a vote of no confidence. Now, this means that Theresa May could have a vote of confidence on her by her own party. Now, the political situation is this, that there is enough people to call a vote of no confidence for Theresa May, but there's not enough people at the moment to vote against her, because there has to be something like 158, 159 votes against Theresa May at that vote of no confidence for her to be automatically removed from her position. So this is the sentiment that's weighing on the pound. And so you can see the pound is falling now, because the market is beginning to anticipate, thinking, oh no, Theresa May might be forced to have a vote of no confidence. There might be a new election, a new leader, and the sort of replacement for Theresa May at the moment is being billed as the old Brexit minister, David Davis. Now remember, he resigned over Theresa May's checkers plan because he was negotiating for Britain in Brussels, and when Theresa May came up with her checkers plan, David Davis thought it's not a good plan. I can't negotiate it. I can't, really back it because it doesn't have my full confidence. So that's, as a consequence, what's happened with the pound. It's being sold off, and the pound is realizing, oh, actually, Theresa May may be in trouble. Now, these are the technical places. The obvious technical place to have entered on that negative sentiment this morning would have been against the 100 or 200 moving average. You see, that was a spike in price that happened late Friday, as there was some rumor came out, or a statement came out that Theresa May was prepared to adjust her Northern Irish backstop plan, and so the market instantly bought the pound really on the headline, and then it sold off as soon as it hit the 100 moving average, because even if Theresa May said something like that, she has to get that through a parliamentary vote in the UK. So the market sold off instantly, because you can promise the world in Brussels, but you have to come back and your own parliament has to vote it through. So that's what happened there. Market opened, negative sentiment, tested up against that 100 moving average and sold off. Now these were the obvious places. If you were convinced that was a bearish sentiment for the pound, the obvious places to sell against with this 100 moving average and 200 moving average. And just by way of a little announcement, I'll talk about this at the end, but we will be doing some workshops on the 30th of the 30th of this, I think it's the 30th of this month. Yes, 30th of October. We'll start some, hang on, let me just get the right date for you before I tell you the wrong date. I'll pop it down here, right? Yeah, 30th of November. We'll be doing some workshops, which will be an hour of live trading with some intraday analysis by myself. So if you're looking at what I've been sharing here about the moving averages, how to work that, don't worry, because if you're really struggling with entering and where to place your stops, where to place your targets, we'll be dealing with those kind of things and looking at sensible places to enter as we do our intraday analysis. So that's just by way of introduction to Brexit. It's going to remain in the spotlight. Brexit headlines will continue to dominate the trading of the pound. So if you're trading the pound, you have to be aware, first of all, that any Brexit headline will move the pound considerably in the current market conditions. And it could be anything. It could be an announcement from Brussels. It could be something that Michel Barnier says. It could be an announcement from the UK government. You have to be tuned in and accept that risk. So some people might say it's more sensible to step aside from trading the pound at the moment. But if you do trade the pound, be aware of the headline risks. We looked at last week's trade. We looked at the latest events. Yeah, and this is the sort of pressure that Theresa May has. You know, on Saturday, the 20th of October, over the weekend, 700,000 protesters went into London, and they're seeking a new referendum. So this is a group that wants to say, no, you know, we want to vote again whether Britain really does want to leave the EU. So you can see there's lots of pressures on Theresa May that she's trying to balance. Okay. So this is just underlining the domestic problems. We spoke about the chairman of the 1922 committee. She has to have 48 votes to trigger a no confidence vote. And if that no confidence vote is triggered, party sources indicate that 100 would vote against her. Okay, so there needs to be 159 votes to automatically trigger a no confidence vote. But remember, and the other thing to remember is if that vote is, if that vote is triggered, a no confidence vote, there's people at the moment that don't vote against Theresa May. But once you've triggered that vote, you can't re-vote for another year. So if the vote does get triggered, all of a sudden, Conservative MPs, Theresa May as part of the Conservative Party, will be faced with a conundrum. They might think, well, maybe they think, I don't want to get rid of Theresa May now, but they might think, but if I don't get rid of Theresa May now, that means I'm stuck with her for another whole year. So politically, if that vote does get triggered, there is a distinct risk that Theresa May will be voted out of her position. So that is a real market risk, and that is the risk that the pound is currently digesting. Hence the pound US dollar pair is being sold. That is the current sentiment. That is the current mood of the market. Now, again, we've looked at sentiment before. Moods of the market, like people, changes, and it can change on a headline, it can change on a new bit of information. So just because that's the sentiment or mood now, the sentiment or mood can change even within the session. So have your ear to the ground, look at the headlines, and you've now got a bit of a background to be able to understand what's going on. It's worth saying that the domestic picture for the UK is pretty good. Recently, the UK wage growth has risen to a 10-year high, and average earnings, excluding bonuses, have delivered 3.1% growth. So you can see here the regular pay, 3-month moving average, see the trend since 2017 to 2018 is up. We now have a very high figure. It was a 10-year high of average earnings at 3.1%. Now, when you have wage growth, that adds to inflationary pressure, which in turn leads to higher interest rates. Okay, that's the chain. Rising wages leads to rising inflation, which leads to higher interest rates. And of course, when the interest rates increase, the pound, the currency, appreciates as well. So that is the sequence of events. And surprise, surprise, the CPI data, that's the inflation data, was up at 2.7% versus 2.4% expected on September the 19th. So it's just worth thinking that, you see, what you're trying to balance at the pound is this, is that, yes, there's a lot of Brexit sentiment, concern and fear about Britain's relationship with the EU at the moment in trading the pound, but the domestic picture for the pound is strong. So what that means is if all of a sudden the Brexit scenario gets organised, or Theresa May or Michel Barnier says we have a deal, and the UK Parliament says, whoa, what a great deal, we're definitely going to accept this, then you're going to see the pound appreciate rapidly. And behind the pound, there's this very strong recently domestic data, increasing wages, and that's starting to show on the inflation lifting as well. So That's all excellent news. And the reason I wanted to sort of particularly draw your attention to this is because we can learn some lessons here from what happened with NAFTA. Now, NAFTA was the North American Free Trade Agreement, okay, and has been renamed recently to the USMCA, and that's the United States Mexico Agreement. Okay, that's the new name of NAFTA. Confusing, I know, but anyway. And what's been happening is that the Canadian, it was said that the Canadian dollar was not fully appreciating, which is US dollar, Canadian dollar bearish. That's a strong Canadian dollar, because of the NAFTA deal. Okay, but then when the NAFTA deal was organised, was sorted, we haven't seen the strength in CAD that I was expecting. And so what it makes you think is actually the domestic data out for Canada has been not so good recently, has been weaker. So what we're seeing that the currency is trading more in line with those recent economic data as opposed to the geopolitical concerns. So that's just worth, marking that point. That and we had at the end of last week, we had some very, very poor retail sales and poor CPI data out of Canada, and so the Canadian dollar rapidly lost value. That was the spike here. It was this was the news candle on Friday, and then we saw price. Let's just see. Let's just get this down to an intraday chart. Yeah, and we saw price. The Canadian dollar was sold off. So got to bear this in mind. We'll come to this pair later because we have the Canadian rate statement coming out. So we'll have to bear that in mind. But just be aware that the latest data out for Canada was poor and was weak, and have a think about the domestic situation for Great Britain and how actually looking at don't lose sight of what the domestic picture is for the currency. That's all I'm saying really with that. It's a small point, but just one I wanted to quickly mark with you. The geopolitical concerns for the US-China trade war. Now, this is something that's constantly been weighing on the markets. And last night there was some quite big moves out of China, particularly the China equity market. And you can see here that the Shanghai Composite was up a full 4.09%. The Hang Seng was up 2.32%. The component index here was 4.89%. There was a good rally in Chinese equities, and a lot of that was to do with the Chinese government reducing some domestic taxes for the Chinese people, and constantly giving their support to the equity market, and they're really trying to talk up the equities now. So it's just to be aware that kind of is been a bit of a relief to the market. And I just want to see here, like the equity markets in the UK up 0.83%, DAX is up 6.5%, the French CAC is up 0.39%, Italian FTSE up 0.3%, overnight Asian trading in the Nikkei was 0.37% up. And now, just as we're approaching the US session, we have the S&P 500 futures, which is this one here, which is 2778 up 0.38%, just as we're approaching the US Open. So in other words, there's been a bit of relief that's come into the markets. So that's just to be aware that in the US-China trade war, we're just drifting into a risk-on sentiment, but that hasn't totally followed through because of the next thing, which is the Italian budget. Now, what's happening in the Italian budget is recently there's been an election in Italy earlier this year. The new government has said we want to run our budget at a deficit of 2.4%. They submitted that to the European Union. The European Union received that deficit, and that was a departure from what a previous Italian government had said. And the European Union are not happy with Italy's proposed budget because they're essentially going to be running their current account at a deficit. In other words, they're losing money, and they're already in considerable debt. So the EU is saying, no, you're breaking our rules. you're in more debt than we'd want a country like yourself to be in, and yet you're running your current account at a deficit. We're not happy at all. Italy have turned around and said, essentially, well, we'll do what we want to do. They've taken a very antagonistic approach. And for a time, that was seeming to work. But then, all of a sudden, it's dawned on the Italian government that if they're so antagonistic to the European Union, that the ratings agencies like Moody's and S&P 500 are going to downgrade their Italian sovereign debt. And that was what has been sort of frightening the market a little bit. And in fact, at the end of recently, what's just happened is there's been a relief for the Italian bond market, because Moody's, the rating agency, have maintained a stable outlook to Italian sovereign debt. So they said, we're not going to downgrade it to a junk status. We're going to say it's okay, it's stable. So that's a bit of relief. But now what the market's looking forward to now is the S&P, Standard & Poor's rating agency, are going to be announcing their view on Italian sovereign debt this Friday. Okay? And if they downgrade the Italian sovereign debt, we're going to see more weakness in the euro, and we're going to see the yields in bonds increasing. Now, bonds are counterintuitive to understand. And if you've never come across a bond before, I'll give you a very brief introduction. I haven't got time for it, but I just want to try and help you, because bonds are a lot of things that particularly currency traders, sometimes people have been trading currencies for a number of years, they just don't get into bonds because they don't understand them, and so they just ignore them. Let me just help you. The way it works with a bond is basically a loan. If you and I wanted to loan some money, we go to the bank. Now, when a government wants to loan some money, they can't go to a bank because of the amount of money involved. So instead, they issue bonds. Now, a bond is essentially a loan, and the issuer, or the person who is receiving the loan, in this case, it would be Italy. They'll say, you buy a bond for a fixed period of time, 2-year, 5-year, 10-year bond, and then you buy the bond for at a rate of interest that is fixed when you buy the bond. So you might, for instance, buy a bond of 10 years, and you're going to receive 5% interest over those 5 years. So if you bought a bond over 5 years for 10% interest each year, you would receive your interest paid twice a year to yourself, and at the end of the period you get the price of the bond back. Now, when you're looking in the markets about the yield of bonds, when the yield is rising, the value of the bond is falling, okay? And when the yield of the bond is falling, the value of the bond is rising. So in other words, what happened here, when Moody's said that we're going to put the Italian sovereign debt, we're going to have that as a, we're going to put it as stable, the yield in the bonds fell, which is a positive thing essentially for the bond, because that means the bond is increasing in price. The yield is falling, so the price is increasing. So it's counterintuitive the way you look at bonds. So when you've been looking at the you might have spoken about the US 10-year treasury yields. As the yield is rising, that means the value of the bond is falling. Okay, so it kind of works the other way around to what you'd expect it to work. And then this was been spoken about last Friday, was the gap between the Italy Germany yield spread, 10-year yield spread here, and the Spain-Germany 10-year yield spread here. The gap between the German and the Italian yield spread was quite large, okay, and with that gap widening, it was widening because obviously there was greater concern. See, here's the Italian in the blue, the yields are rising because the price of the bond is falling. The market's concerned about the Italian debt, so that's why you have the rising yields. And that gap getting bigger between Italy and Germany, what that tells you is that there's a greater disparity between the strongest EU nation, Germany, and Italy, and of course that is all going to be weighing on the euro. So that sort of negative sentiment has been entering the markets, just sort of countering a little bit of the risk on sentiment that we have. Commitment of traders report, there's nothing particularly to mention here, just there's less pound shorts. in the market than there has been, and of course some of those shorts are being added to now since we've seen in the market there's shorts being added to the pound now for sure. You can just see the pound is still falling on the back of that sentiment. When we start to look at the week ahead, we have the main day. Okay, we have Carney speaking on Tuesday. Not expecting particularly very much from him. Again, it's Brexit headlines, which is the big issue. We have a couple of speakers out of Australia. Remember, the Australian currency is affected by Chinese data, so the recovery in Chinese equities will be positive for the Australian dollar, certainly in terms of sentiment. But the Australian dollar itself is under pressure, and we got quite a week ahead for Australia. Just got these couple of speeches out on Monday and Tuesday, so just worth having a look to catch what they're saying, and they may mention the recovery of the Chinese equities, which is going to be assisting and helping the Australian dollar. On Wednesday, we have the Bank of Canada rate decision and rate statement and monetary policy report. This is, a very important announcement. It's probably the most important announcement of the week. And the Bank of Canada is expected to raise interest rates at this coming report. So going back to the US dollar Canadian dollar pair, okay. Now the market's always trying to look ahead. Okay, so the market kind of is anticipating the Bank of Canada raising interest rates. So that's kind of being priced into the markets. Now, the reason the Canadian dollar sold off on Friday, as we already discussed, was because of the weak retail sales data and the weak CPI data, and there were big misses on both of them. Okay, so what the market's thinking, well, then when the Bank of Canada meets on Wednesday, are they going to be saying, yes, we're hiking interest rates, that's expected, and we're expecting to hike more interest rates? That's what the market's looking at. What is their intended path from here? That's what the market's trying to understand, trying to anticipate. So as we go into Wednesday, what we need to think about is, how is the Bank of Canada going to be interpreting the recent data? And the market has been saying, well, we think that the recent data has been poor, so therefore when the Bank of Canada meets, they're going to hike, but it's going to be a kind of a dovish hike. They're not going to be necessarily signaling any more rate hikes that are going to be continually coming one after another. That kind of would be the most hawkish approach. So that's something to be aware of. And on Wednesday, we need to read what that rate statement is. Okay, so if you go back here, you see the Bank of Canada interest rate decision and the rate statement. Okay, you can read what that rate statement is. Okay, I'm not sure if you hit that link. Let's see whether you get that there. We'll see. No, it's not that. It's not there on the link. So what I would suggest is you go to the Bank of Canada website. And when you go to the Bank of Canada website, you can see what that rate statement is, and then the market will respond and react to that. So if the Bank of Canada is saying, okay, yeah, we've had some poor data out recently, and that's going to make us think very carefully about raising rates in the future, then you're going to see the Canadian dollar sell off, and you're going to see the US dollar Canadian dollar pair appreciate. Okay, so that's what you have to be factoring in. Remember, the market is expecting the Bank of Canada to raise interest rates, so that's not a surprise now. So what the market is trying to now factor in is, what is the likely path of interest rate increases or decreases that are coming up? We can't know that in advance, but what we can know is the recent data has been soft out of Canada, and because the recent retail sales data and the recent CPI data has been soft, it's more likely that the Bank of Canada is going to be slightly more dovish in their approach. So therefore, when that rate statement comes out on Wednesday, we need to think. So you can see now that so this area here, that 50 moving average, would potentially be a good place to rejoin US dollar Canadian dollar longs, or certainly this 100 moving average looks a good place to rejoin longs. Kind of, I'm in two minds here, and because what you typically see is in the run up to the meeting, like the day of the meeting, then you'll typically see the Canadian dollar appreciate. Okay, so come Wednesday, just before the meeting, what you'll typically see is the Canadian dollar appreciates. So there'll be a spike down, and then the market's looking at the rate statement, and then you can quickly see that spike reverse if all of a sudden the Bank of Canada is saying something contrary to a bullish position. So that's what you typically expect. So come back here on Wednesday, have a look at the chart, but what you'll typically expect is a spike down on the news, and then a quick buy back up, and possibly a flick in the other direction. That's what I'm expecting. But again, you have to read the rate statement to get that path of direction to really understand it. Now, the Thursday, we have the ECB interest rate decision and monetary policy statement. Again, that's important. The ECB, we know that they're due to stop the quantitative easing program in December of this year, and they're due to raise interest rates in the summer of 2019. So any deviation from that path will see a reaction in the euro. So again, this is what we're expecting. QE stopped in December, and the interest rate should be, the first hike in interest rates should be in summer 2019. So that's what the market's going to be looking at the policy statement, looking for the press conference. Any deviation from that policy? What are they thinking about the Italian budget woes? Are they concerned? How is that relationship between Italy and the ECB? How is that carried on in the next few days? How does the Italian government respond to the EU? How does the EU respond to the Italian government? If the Italian government continues to be antagonistic and combative, which they have pulled back, then remember that the ratings agencies are going to rate their sovereign debt as less reliable, because who wants to be borrowing money from someone who just spends money willy-nilly? It's common sense, isn't it? If you think the government is irresponsible, then you're not going to recommend them to lend them money, because you know that if you keep spending irresponsibly, you're not going to be able to pay back your loan. So it's no different to what you'd normally expect of a family member or a friend or taking a loan from a bank. So the ECB statement, you've got the things to look at. And then if we look at the chart, US dollar chart, we can see, look, you can see again, look, the 100 exponential moving average on the 4-hour chart was a good place to sell against. This sentiment, this negative sentiment I've been talking about, is firmly in the market, this Italian budget concern. You can see that the 50 moving average played a very good line of resistance there, and coming up we again have the 200 moving average and the 100 moving average as excellent places to enter shorts. And very difficult to see the euro going above the 1.1600 level at the moment. Very hard to see it with all the budget concerns about Italy and how that's weighing on the euro. So a return into this kind of area is potentially good for a short, obviously depending on why price returns to that area. If it's if price returns to that area because the Italian government suddenly turn around and say, oh yeah, we've seen the error of our ways, we're not going to submit a budget deficit anymore, we're going to change our budget, and we're going to move in line with what the EU are going to say. Of course, it's not going to happen, but if it did, and then the euro recovers up to here, well, it's going to carry on this way because the risk and the concern has dissipated from the market. So then on Friday, let's just see, yeah, it's Friday, we have the Draghi speech again. So okay, when you got a speech just after the rate statement and the press conference, the reason to look at the next speech the next day, because the market will react and respond to this, and then the next day Draghi's got a chance to say, well, yeah, the market's reacted correctly or wrongly to it. So that's something to flag up as well. Got GDP data out of the US and CPI data out of the US again. That will be key to look at. You've got 2% expected CPI and 3.3% GDP annualized expected. Just want to have a look at that and see if that bullish picture for the US dollar is still in place. That brings us to the end of the week, and I think that is a pretty it's a pretty busy week with lots of different factors to consider. If you've got any questions now, just type them in here. But as I said, I nearly forgot, I will remind you again, because we've got it coming up. You can pop your questions in while I'm just doing this. Got the workshops coming up on the 30th of November. Now, I'm excited and looking forward to the workshops, because they're going to be opportunities to kind of really get into some of the nitty-gritty of trading. We'll be looking at a live market analysis as it's actually happening, and we'll be looking at the sentiment of the market. So how do you analyze what sentiment is happening right there and then? So we'll take our session, we'll start our session, we'll look at the current sentiment in the market, we'll look at strong currency pairs, weak currency pairs, and then we'll start to highlight and identify good places where it would be sensible to initiate trades from. And we'll be looking at those and be drilling down to the 15-minute charts as well. Try and show you some trades in action as well. So there'll be a mixture of the longer term picture and looking at some shorter term picture as well. Okay, Khalid, got a question from you here. Yeah, Khalid, do I think the pound will move up this week or not? Well, again, the thing with trading is you can't see the future, Khalid. All you can do is to define and limit your risk. Now, as I've been saying, the pound is being sold off heavily at the moment for the reasons that I've outlined, Khalid. And the reasons is big concerns over Theresa May and whether she will hold in her position in the UK government. Will there be a vote of no confidence? Will the 1922 committee meet? Will they send 48 letters to the chairman? Will the chairman call a vote of no confidence? And if the vote of no confidence is called, will they vote against Theresa May? Khalid, these are the sort of things that will see the pound, if those series of events happening, you're going to see the pound fall down, and the areas where you're looking at, the next kind of major lows are here on the weekly chart. You've got 1.2700. So you can see, look, we're heading down to those loads, Khalid, at the moment. So that's where we are. We can see risk can be defined and limited above the 150 moving average there. So if that sentiment carries on, the obvious place to enter short will be to enter short on a retrace back up to the 50 moving average, your stops above the top, and then playing down to the lows again. So Khalid, if that answers your question, you have to do the hard work, Khalid, and read the news and the sentiment. And as you understand what's happening in the market, then you'll understand where the pounds will be going. So, no one can see the future. You can't see what headlines are going to come out in advance. All you can do is find key places to define and limit your risk. Oh, good, Khalid. I'm glad that's helped you. I understand your question, Khalid, but you can see here, look how the moving averages provide good places to define and limit your risk. So we were looking here at the beginning of last week, and we saw that there was lots of reasons that you could sell the pound. They were there in the market, and the market gapped to the downside, and we thought, you know what, there's strong reasons to sell the pound. And I said at the time, Khalid, I said, look, and a good place to sell the pound was up here against the 200 exponential moving average. I said that's the sensible place to sell. So sure enough, price returned the 200 moving average, and then price fell off. And now you can see, yes, that was a very sensible place to sell the pound. And the way you would have managed it, just how does price react around the 100 moving average? Oh, look, it's gone through. Oh, it's gone straight through. Oh, it's gone through the 50 moving average, and then price again reacted there and there and there. And so you could have trailed your stop down as price is being rejected at these different levels. So that's the sort of way you play it. Okay, guys, I think that's the end of our time now. I'm looking forward to the workshops that we're going to be doing in the future. And of course, I look forward to seeing you again next week on the 29th of October, same time, same place. I hope you have a lovely week. Thank you very much for attending HYCM's webinar. If you have any questions about platforms or how to place trades or opening accounts, please do contact support, and we're very happy to help you with that, because you will need to have an account with HYCM, at least a demo account, I think, in order to take part in the workshops that are happening on the 30th of November. So it would make sense to get that all sorted and organized as quickly as possible so you can start straight away. Okay, guys, thank you very much. I hope you have a good week. Goodbye.